Good afternoon again. Just a reminder, everyone, as you enter the Zoom room, please place your name, agency, and tribal affiliation in the chat box so we can have a feel for who our listeners are today. We'll start in just a second. And this is, again, session 3 of a 6-part session of the Board of Directors training series for the National Council of Urban Indian Health. The theme for this training series is creating resilient board of director members in the era of COVID-19, and I'll be your host today. My name is Mark Clark. I'm Senior Program Manager for Technical Assistance within the National Council of Urban Indian Health. Would you advance to our next slide, please?
Sure. Maybe.
Thank you.
It's just a second. Technical difficulties, just a second. There.
Thank you. Just a few housekeeping ideas. This webinar is being recorded. This is a 2-hour session. We'll have a brief break about halfway through, maybe a little later than halfway. Your mics will be muted unless otherwise noted. There will be opportunities for chat, and throughout the session, you'll be able to enter comments in the chat box. We'll keep our eye on the chat box so we can alert Lori when questions arise. You can type those questions into the chat box at any time. You also have a reaction feature at the bottom of your screen on the lower right end. Reactions include a thumbs up, other kinds of indicators of your pleasure or displeasure as we go through each slide. The Q&A session at the end of this session will be another opportunity for open dialogue. The slides and recordings will be available very shortly, available to all members. And finally, at the end of the session, we'll have a link to an evaluation, online evaluation we'll ask you to complete so we can collect your feedback about each session. Next slide, please. Now, for those of you who are new to Zoom, it's helpful to get a little bit of an idea about how to navigate the screen. The chat box is, again, at the lower portion of your screen. You select the chat feature, and you can, text box will pop up, and you can move your cursor and enter your comments there in the chat room. The chat features allow you to either share chats with everyone in the room, or you can have a private chat as you so desire with other attendees. Again, the chat feature is designed to create a space for open dialogue. You can enter a chat or a comment at any time during the presentation. Your comments will appear in the chat box, and again, you can select a feature that makes sure that everyone can see your comments when you use the chat feature. Next slide, please. Today's session, again, session 3 of a 6-part session, is entitled Understanding Finances for Non-Financial Leaders. It's particularly a timely moment to offer this guidance to novices, and maybe a refresher for more seasoned professionals who are accustomed to making financial plans and financial decisions as board members. So we're pleased to have Lori Linder available to share her expertise with us. Next slide, please. Lori Linder is a healthcare executive with over 37 years of broad leadership experience in a multi-site health system, community hospitals, and large private and national medical groups. She has served as a chief financial officer and chief operating officer in both the for-profit and nonprofit sector. There are two contact available, the links for Rising Stars, the LLC, and a personal email for Lori as a Gmail. Those references will be part of the saved slides as well, and you'll be able to connect with her or with Rising Stars in that way. Rising Stars is a leadership organization. It also features a free newsletter, and you can connect with Lori via her LinkedIn page as well. Next page, please. Next slide, please. So without further ado, I'm going to pass the baton to Lori Linder and let her get started with today's presentation. Thank you. Lori?
Thank you. Good day, everyone. I'm saying good day because just depends on where you are in the United States. I don't know what time it is. Anyway, I'm very excited to be presenting to you today. I did look over the list of participants, and I see that probably about 2/3 of you are relatively new board members. I have created this presentation with the thought that you are new to finance and going over what I consider the most informative financial reports that you would need in being a board member and understanding what's going on in your organization. Hopefully it's not too elementary. If it is, it's a refresher course. And if it's not, it'll give you enough information to work with your finance representatives in understanding your particular program or health center as you navigate through some difficult times and hopefully some better times to come when it deals with healthcare and finances as we move forward. The learning objectives for today is really to give you the basis to understand the financial efficacy of your centers, learn how to read and interpret the 3 most useful financial reports of any organization. And just as an overview, that would be your balance sheet, your income statement, and your cash flow statement. And I'm going to try and give you some pointers as to where to look in your financial decision statements to help in the critical decision-making that we have going on, unfortunately, in today's healthcare climate and into the future, as healthcare continues to be a dominant player in how we are progressing forward in this economy. I'm going to talk about the balance sheet. Frankly, what is the balance sheet? It's an overview of what the organization owns and owes during a point in time. What it owns is on the left, what it owes is on the right. It is a statement of your financial position. And since it's a statement of your financial position, I like to think of it as a picture. So I put a camera at the top so you can identify it is a picture for a point of time that is going on. The income statement on the left is another financial report, and it is an overview of your profit or income of the organization that is generated in the period. It's noted as to be your revenue less your expenses equal your profit. I notice in the Indian health centers, you note that your profit as net assets. So it is interchangeable in that way here. Your cash flow statement is what your organization generates and what it spends, what cash it generates and what it spends over a period of time. It is, an example would be what your cash is at the beginning of, I believe most of your most of you are on a fiscal year of July 1st, but regardless of when the start of your year is, it's what cash you've brought in, what cash you've spent, and then what's your cash at the end of the year. It is your most fluid. It is probably the most useful statement that you will have because it tells you immediately what your financial cash position is in order to make decisions. I look at the income statement and the cash flow statement. It's the flow of money during a period of time. whether it be a month, a quarter, a year. And I think of it as a movie. Each has a focus, okay? It has its own focus. So I put a movie reel over there so you can get that idea. Very simply, on the balance sheet at the bottom, on the assets, which is on the left, is to equal the liabilities and your equity on the right. You always have to have it in balance, hence the balance sheet. The current assets on the left is your cash and other assets that you expect to be converted to cash within the year. A good example would be your revenues from services provided, whether it be from your grants, from federal monies, from Medicare, Medicaid. It's your cash or receivables that you expect to get in that period of time, and that you convert to cash in that period of time, within a period of time. Your non-current assets would be longer term investments that you cannot convert into cash quickly. It could be property, plant, equipment that would take you a little bit of a longer period of time to convert to cash if you had to dispose of any of those assets. On the liability side, what we owe, your current liabilities would be what the amounts that are due to be paid to creditors within 12 months. Perfect example of that would be your accounts payable invoices. If you received supplies, PP&E during COVID that you were invoiced for and you have not yet paid. It would also be any personnel expenses that are due to people, whether it be paid time off, that maybe you didn't expend that moment, but it's a liability until you actually pay that time. If I'm going too fast, please let me know. Your longer term liabilities or your non-current liabilities are items that are to be paid after the period of 1 year. Example would be if you took a loan and it was to be paid back over a longer period of time, the portion that's not to be paid back in that year within that year, the current portion, it would be considered a non-current liability. And the equity would be your retained earnings, that is left over from your revenue, or in your case, it would be net assets, I believe. That would be your retained earnings. We doing okay? Give a wave if we are. I'm having challenge seeing my little screen at the bottom, so if you're giving me a reaction, oh, I see it now. Thank you. So what I've given you is I've taken one of your health centers, I've taken their name away so I could give you an idea of what their balance sheet happens to look like for the period ending June 30th, 2019. As I've said, on the left is what we own, on the right is what we owe. In this case, you see the cash and the cash equivalents of a little over $9 million. You see there are some investments, and you see that there's some patient accounts receivable net. And then there's grants. On the right is your accounts payable, accrued expenses, that personal time off I was referring to, as well as your due to Medicaid for any settlements. On the left, the top portion of the total current assets is what we would call the most liquid, which means that which you could convert to cash and use immediately if need be. The property and equipment we consider less liquid, meaning it will take you a period of time to divest of that if you needed to, if you needed that cash. You could do it, but it wouldn't be readily available to you. On the right is what's due first. These are the things that you owe immediately or within that year's period of time. And so you need to be able to understand that you really need to have the current assets on the left in order to pay the liabilities on the right. The due last would be, like I mentioned, a loan or a note payable that's not the current portion due. It's like your mortgage. That's what I think of as a note payable. Just like if you have a house mortgage, you have amounts due every month within the year, and then you have however long you've taken for that mortgage, that is considered a longer period of time and not due immediately. And then in your organizations, you have net assets without donor restrictions, excuse me, and a little less with donor restrictions. And as I understand it, those with donor restrictions are assets that have a specific area of focus, and you can't use it unless it's for that purpose. If you notice, the total assets on the left of almost $28 million equals the liabilities and equities on the right of approximately $28 million. So that's why they call it a balance sheet. Again, in this organization, the cash and cash equivalents, the patient accounts receivable, and your grants and contributions receivable make up the majority of your current assets. In this case, it's almost $15 million. On the right, if you take into account the accounts payable, your accrued expenses, your personal time off, and your due to Medicaid for PPS prior period settlements, those four items make up almost $4.7 million. So what you can see is you have current assets here of almost 15 million, and you have the largest current liabilities of almost 5 million. You're in a pretty good position right now when you look at it from a balance sheet of having those dollars to pay for your current expenses. Now, I will say that collecting of your patient accounts receivable is very, very important to maintain, to convert into cash. So if you're struggling for collecting on those receivables, then you have to develop processes to help assist with that going forward. So that, and we'll talk a little bit more to that as we go forward. Due to Medicaid on here, your PPS settlement, that's really money that you were paid an approximation at the time that services were rendered under Medicaid. They paid you an estimate. And a lot of times what happens is when you file your final reports, it may say that you have overpaid. And in this case, it looks like you're due to pay back to Medicaid $2.2 million. So it's all based upon an estimate of services that were provided to your patients during that period of time. Not everybody may have that. It is common to pay back Medicaid, how they estimate payment to you based upon cost reports and settlements. It's not uncommon to have to pay back, So I wouldn't let that worry any of you if you see that. It is the way the program works with both Medicare and Medicaid in terms of doing cost report settlements, and that's really what this is. As I said to you, the income statement, it's a snapshot. It's this case, a focus for a period of time. It is your profit, or in this case, your net assets in this organization. It's the revenue that you're generating, whether it comes from the patient, whether it comes from your IHS allocations of money, whether it comes from Medicare or Medicaid, or I notice you also have some veteran reimbursement. It's all your revenues in, less your expenses, your personnel, your supplies, your property that you, or your equipment that you utilize, your rent, your those types of things that you expend in order to provide services. The net of those two is your profit. So again, the definition here is, it is an overview of how much an organization has earned over a period of time. Income statements, or in your case, statement of activities, come out monthly. There's also quarterly reviews, looks, and then of course the annual look. When you read and analyze the income statement, you'll learn a lot about how your organization works. It's also a place to look when you are in critical times of where you might need to cut some expenses. You would want to look at your income statement to see where you are indeed spending your money. Here's an example of your income statement or statement of activities in your organization. I noticed that in this organization, the health center lists all its revenue in a combined way, a combined setting. So all of your programs, the revenue is showing up in the revenues in support. Again, your patient service fees, your capitation revenue, your grants, your contributions. These are all the revenues that you've generated during that period of time. Down below are your functional expenses. These are the expenses associated with all of the programs in your specific health center. It may look different. This is just a snapshot of one health center. It may look different for your specific one, depending upon the programs that you offer. Again, all patient revenues that are generated is at the top. The net earnings that come after your expenses is at the bottom. So in this case, this organization had about $33 million in revenue generation. It expended a little under $31 million. And it shows that the net asset change was about $2 million in that time frame. So again, we would look at that as being your net, your profit at that time. Does all of this make sense? Yay, nay, hopefully. We like to talk about, if you ever hear finance people say, well, the top line. Well, the top line is your revenues, okay? I just have to tell you, we like jargon in the finance world. So we tend to talk in lingo. So there's the top line, and then of course, the bottom line.
Excuse me. Oh,
yes.
Lori, I just wanted to note that there was a question in the chat box.
Oh, let me get in there just a second.
Sure. I'll read it to you. Should depreciation and investment gains or losses be reported on the income statement?
Depreciation is indeed shown on the income statement. In fact, I'll show you on the next slide all that's in the functional expenses. The depreciation is considered an expense. You will see it on your income statement. So let me go to the next slide. Let me see if this, which is, I'm going to be showing you an example of the medical services program. So if you look at the medical services program in this health center, you will see midway down depreciation and amortization. That's the depreciation. It's considered a non-cash expense, but we do include it on the income statement, the depreciation of that asset that has happened at that point in time. Does that answer the question? Gains or losses would be really shown more on the balance sheet side of that. But the depreciation and amortization a lot is the goodwill. A lot of time when you acquire an asset and it gets amortized over time, like goodwill would be amortized over time, meaning that you bought something that doesn't necessarily have a cash value. It has a goodwill associated with it. And let's say you bought a book of business that had a large clientele. That client that you're paying for that clientele, that would be considered goodwill. You're paying a price for those folks that they will continue to buy from you. That would be called goodwill. Is there another question? I can't.
Participants can unmute their mic using the features on their Zoom controls to follow up on that question.
Okay. So again, this is the expenses that I would encourage as board members when you're going through the financials with your finance folks. If you're looking at where your money is being spent in your specific programs, this just happens to be the medical services program that I pointed out. This is where you'll find your personnel expenses, all the salaries and wages that you've paid for your book of business over a period of time. Any contractual services, if you contracted, it could be a contract with a vendor. It could be a contract with a personnel, a hiring firm. If you had to get in contract labor, a lot of times organizations put that in their contract services to separate it from their personnel expenses. Your finance person should be able to help you drill down on what exactly is in that contract services line. The supplies, that's probably that, and personnel and actually contract services are the big items in your organization. Obviously, the supplies that are needed to care for the patients, to run the organization. And as you can see, I mentioned the depreciation, the amortization, any professional services that you have, and then there's a category that's all other expenses. So this would be, as you're going through and you're seeing that perhaps you need to, that your revenues are falling short, that you would have to look at your expense side of it to see where it is that you might be able to cut some expenses. Okay. Why am I not? Ah. So before I go forward, any other questions on the balance sheet and the income statement? Okay. I want to see how I'm doing on time. I actually think I'm doing okay. The next is your cash flow statement. And again, I said to you that your cash flow statement is probably the most accurate depiction of what your organization looks like. And why I say accurate is a lot of times on the income statement, you have accrued revenues and you have accrued expenses. That means that you expect to get paid, or you owe back. On a cash flow statement, that's the cash you have. That's the cash that you have in the beginning of the year or whatever period of time you're looking at it. It's the cash you paid out to pay for the things that you acquired. And it's the cash at the end of that period. That is just what it says. It's that period of time and what you have available to you immediately in cash. And it's more straightforward than the income statement is probably the better way to say it. The income statement is correct. Most organizations, especially healthcare organizations, accrue their revenue and accrue their expenses. That is a perfect representation of how to look at things. The cash flow just says, okay, these are the dollars I have in my wallet to spend, and that I know that I have right now. Okay. We often call the cash flow statement sources and uses of funds. I don't want sources being what brings the cash in, the uses is what we're paying for, and then the cash out at the end of the year. I often think about it as my checkbook. The cash is going out really, really fast. So I have to look at that and balance that every single month. So I know, make sure, as a finance person, I do balance my checkbook. A lot of people don't, but I have to make sure that I have the money in there for what I need going on. Think of your balance sheet or your cash balance and your cash flow as a rubber ducky in a bathtub. Okay, the rubber ducky is in a tub, and that tub is balanced with water. Okay, it's balanced. You don't see that little duck sinking or flowing over to the side. In this case, the dollars are coming in from the spigot, and the money that we pay for things is going down the drain. And the objective is to keep it balanced. So you want to have enough money coming in to balance out what is going out. And so I often like this analogy because it's easy to see. When you're filling your tub, you want to make sure that it is balanced and you don't have an overflow situation. So again, your cash balance is your rubber ducky in a balanced bathtub. Your cash in and your cash out is what is considered cash flow. Cash is king, and we all kind of know that. It enables you to do a lot. It's the money you have. It allows you to grow. It allows you to invest. You could be your investment in equipment to maintain your state-of-the-art centers. If you don't bring in the cash and you don't continue to grow, you basically have a situation where your game is over. You have to figure out how to make this work. And so it is a balancing act. There's no doubt about how things are going, that in order to grow, it takes money to grow. And obviously when you grow, it also takes money to spend, to buy things so that you continue to provide the care that you want to continue to provide. And actually, in a lot of times, to try new programs. You know, when you want to invest in a new program, you will not have the money necessarily immediately. So it's nice to have money out there that would let you invest in that program with the return of that cash to come over a period of time. Your cash flow and your strategy go hand in hand. I know you recently had a session that really talked about the strategy from an emergency perspective right now with what's going on with COVID. But to go beyond the COVID environment, every board, every organization should have a strategy in mind as they move forward to continue to grow their organizations. And so when you're thinking about that strategy, and you're thinking about what it is that you want to provide going forward and what kind of services to provide, you want to actually do forecasts that will tell you, if I do this service, if I provide this service, will I have the wherewithal to do that? And will I be able to have additional net assets to grow my business? And you forecast that. In a lot of organizations, when you are developing a 3-year plan or a 5-year plan, you will also develop what are called financial forecasts. What do we think that will look like? So you would estimate, you'd sit and say, okay, how much volume do I think I would get? Am I going to get any grants for this? So what are the revenues? What kind of expenses is it going to take to provide those services? And then you evaluate that strategy and the finances and you say, can I afford to do this? And it's really an iterative process. You know, you just don't do a strategy or strategic plan and say, okay, that's my strategic plan and I'm going away. That's what it's going to look like. Nothing's going to change. I mean, in today's healthcare environment, your strategic plans have to be refreshed ongoing. You know, at a minimum, I would refresh it every year. In a lot of cases, you have to look at it, see how you're working towards the plan on an ongoing basis. But things change so rapidly today that you just don't create a plan and put it on the shelf and say, okay, I'm good for 5 years now. And as a financial person, we used to say that the financial projection is perfect at the moment you produced it. Tomorrow, it might be different, okay? So as a board member, it's really important to work with your finance folks, work with your executive directors, ongoing, look at what you're doing. Know that things change so rapidly that you have to refresh everything you're doing on an ongoing basis. That's your obligation as a board member with your teams. The cash flow statement has 3 elements to it. The top would be the operations or operating element. That's what you're doing every day in your health centers. The second would be investing. If you have money that you're going to invest for future dollars. Investing, I will go into that. That would be things like your capital expenditures. You're investing in equipment to provide services that you want to provide and need to provide to your patients. I will say that you're investing, when you look at it on a cash flow statement, it will usually be a net negative number because you're paying money out in order to acquire that capital asset. your operating, let me go back up onto your operating, that's where you're going to see where you're collecting from your receivables. Excuse me. The money that's due to you, whether it be from the patient, whether it be from a grant, whether it be from Medicare or Medicaid. This is where you're going to see the money coming in. You're also going to see the money going out. That is when you're paying for your supplies or your personnel. That's where you'll see that all up in the operating. And we would hope, every organization hopes, in order to survive, that number really needs to be a net positive. Okay. And then your third element is your financing. And that would be it could be either way. It could be an inflow or an outflow of money. But in most cases, it's taking on some debt. If you were in a situation that you needed to borrow money, in the debt expense of that would be a negative number. Of course, the cash coming in would be a positive number. But you would look at it on the cash flow statement as payment on the principal or on a loan that you took, sort of like your mortgage. Again, we often call the operating element a cash flow from operations. You'll see that on the cash flow statement. Investing would be labeled cash flow from investing, and then cash flow from financing activities. Here is an example of your cash flow statement for one of your health centers. Your operating cash is that line that says net cash provided by operating activities. In this case, it's a net positive, and it's about $500,000. The second part is the net cash used in investing. This health center decided to invest pretty heavily in this period for this year in some property and equipment. Okay, they felt it was the right thing for them to do at this time. That was about $1.6 million. What you're going to see is that investing, as I said, is usually a negative number. You bought something, so the cash, it's a source of cash that you paid for, and so it shows as a negative number. You invested in an asset for your organization. The financing is this health center actually borrowed some money at some point in time, and they had to make a payment. Remember I said a principal on a loan payment is a financing. It was a negative number. $51,000 of loan payments were made. Oops, sorry about that. If you look at the bottom where it says net increase or decrease in cash and cash equivalents, you actually had a net cash decrease for the organization during this year. In this case, it's not really necessarily a bad thing because you invested in purchases of property and equipment. You invested for your future. If you had cash outflows that were not positive on the operating side and it was negative, then you sit back and think, should I really be investing in something right now? You have to weigh with your organization if it makes sense to have done that, because at the bottom, you still have $9.2 million in cash and cash equivalents. If you remember back on a previous slide, I showed you that what you owed currently was just under $5 million. So it made sense to invest in that property and equipment. If your financial position was not as solvent as this showed, and you had a negative cash flow, then it might tell you that you need to react as an organization, that perhaps you shouldn't have spent the money this year, or what other things might you need to do in order to shore up the cash that you have as an organization. Is that all making sense? I see a thumbs up. Okay, thank you. I'm having a hard time seeing the chat box, so I apologize. Cash flow really tells you, is your organization healthy? Okay. Do you have the cash coming through that you don't run out of money? Simply, your income that you generate less the expenses that you pay for that is your cash flow. You either increase your income or you reduce your expenses. And I'm going to say that's the easiest way to change the cash flow, but it is. The challenge is when you have the need to improve your cash flow is figuring out, how do you bring in more income? How do you collect more on those receivables? Or how do you do new businesses? Or maybe in the cases, if you're having a really challenging program, is it time to divest of that program? Those are harder things to do. None of this is easy. It's just, those are the things that you will have to evaluate with your organization. The cash flow is like looking at the gas gauge in your car. When's it time to, and how will I fill it back up? And at what price will I fill it back up? So again, it is challenging. I in no way want, the really important decisions is with you as a board, your finance people, your executive directors of your health centers, is what should we be doing to grow our organizations and improve the financial positions. These three reports are the three most fundamental reports that you will use as a board member with your organizations. You're not supposed to be the experts on this. Your finance people should be the experts on this. But when they present to you during a board meeting or at other times of the year, this should be giving you basically a framework by those places to look in those statements to see how your organization is doing. Well, this is supposed to be a break for you now. Are there any questions that I need to answer before you take your break?
Lori, just to let you know, I keep an eye on the chat box, and I'll certainly alert you as questions come in.
Okay.
Thank you.
So I believe now it's break time. I believe we've allotted 5 minutes for break. And then we'll go over the last section of it. So again, thank you for allowing me to present. I hope that it does help you some in understanding. And you'll have these cheat sheets later on, I understand, so that'll be great. So enjoy your break.
Thank you, everyone. You could just signify your return to break by turning back on your video when you return. Thank you, everyone.
Okay, baby. Okay. Welcome back, everybody. Can you hear me? Okay.
Yes, I hear you.
Okay. I saw some shakings of heads, so or a thumbs up. I appreciate it. The last part, and I noticed, I don't know if they're on, but I noticed one of your health center CFOs was on the call. Again, I hope I'm doing this presentation justice. If I'm not, uh-oh. So, but now I'm going to take you to the very last section. And these are things, they happen to be the financial ratios. And you are not expected to understand how to calculate these. When I go through them, just a second as I do this again. Excuse my dog in the background. I apologize. She's been quiet. Libby, shush. These ratios are, there's lots of financial ratios out there. The ones that I am giving you today are the ones that probably are the most prevalent in determining what you need to do in events of changing your financial position of your health center, okay? The first one I'm going to go through is your liquidity ratio. It really shows how easily an organization can pay its debts, as simple as that. And if you remember from the balance sheet side, I showed you previously, what we owned was on the left, which were our current assets. What we owed was on the right, which was our liabilities, our assets and our liabilities. Excuse me again. The current ratio takes your current assets, your cash, your patient revenues, your patient revenues, your anything that is current that you can convert into cash in a very short amount of time, and you divide that by what you owe. If you think back on one of the previous slides, I showed you, you had current assets somewhere around the 14 or $15 million mark. And then you had current liabilities that were somewhere around $5 million. So you would divide the $5 million into that roughly $15 million, and you would get a ratio. And of course, the higher that ratio is, meaning how easily it is for you to be able to pay the debt you have, is better. You have less risk and you're better off. And that health center that I showed you, the higher amounts, you really had great current ratio. So there wasn't that much of a concern about paying that current debt during that period of time. Your days cash on hand, that's really what you need to look at in terms of uncertainty. That would be how much cash you have divided by how much you're spending on basically a daily basis, okay? Days cash on hand. I don't know what the prevailing is for the Indian health organizations, but obviously you'd want to have cash on hand somewhere around the 90 to 120 day mark. And that's not always, that's not a solid number, but that just would say that if you had that much cash readily available to you, like with COVID, it would tell you, I could pay for maybe that extra personnel that I need to bring on because I have to have coverage. I have, my staff is getting sick also. How do I bring in some other staff? Or the PP&E equipment that you need or supplies you needed to bring on, or the extra cleaning that you needed to do, So obviously you want to know that you have money there to pay for these things for an unlikely event. So again, working with your finance person, like I said, I don't know specifically what you have as an organization, but those are the things as a board member with your finance teams or representatives, your treasurer, your executive directors, those are the things that you need to be looking at now and into the future as we go through these uncertainties. The next ratio, important ratio for you to understand, are your profitabilities. Again, I know that as I've worked, the majority of my life has been in not-for-profit organizations. The first question out there is, we're not here to make a profit. When we say profit in a healthcare organization that's not for profit or has mostly grants, you're not giving money back to a board member per se, or to a stockholder. You're investing. Making a profit allows you to invest back into your organization. Saying that you're not going to make a profit profit margin as an organization would be challenging. You do have to have money left over to reinvest into your company, your organization as it goes. So the profitability ratios really tell you how good an organization is at making money. And the ratio is your profit divided by your revenues. So if you remember that in the health center that I provided, your profit was also known as net assets. That is what they called it at that health center. You would take that number, that net asset number, and you would divide it by your revenues. Okay. And the higher, obviously, the better, the more money you have. The goal is to earn more margin for every dollar of revenue you get. Okay. To have money left over. Again, having money left over is okay. It is a way for you to reinvest back in your organization. So please don't think that having money left over is a bad thing. Okay, it's not bad for your patients to have money left over. It's what's due you in order to invest and grow your organizations. And actually, having that margin allows you to have money available for those uncertain times. There's also things called leverage ratios. This leverage ratio can tell an organization how much debt the organization is using to make it run and stay alive. If you are bringing on more and more debt in order to go forward and to keep your organization staying alive, that's going to be hurtful in the long run, because obviously you have to pay that debt back. It's not like it's forgiven for you. So if you take a loan out and you have to pay it back. So you want to be very careful about how much debt you're willing to take on and your future ability to pay for that. This leverage ratio tells you how much in terms of percentage of an organization's assets are paid for by debt. So in other words, if you're bringing on debt to pay for things, that debt to equity or debt ratio is going to be very difficult for you going forward if you don't figure out ways to grow your business or reduce your operating expenses. So again, lower debt says that you're safer. It'd be the same thing in your own personal lives too. that, obviously you don't want to take on too much debt if you know that you're not going to be able to pay that back. Also, don't be afraid to take on debt if you have a short-term issue going on, okay? It's not to say never to take it on. It's saying, let's make sure that the reasons that you're taking it, that you can, if it's to help you get through a hump, but because you'll come out better on the other side, great. That's the reason why you take on the debt. Probably the other one that's very important and should be very important to your organization is your efficiency ratio. And the one here is your accounts receivable turnover. How long does it take you to generate cash or income from your customers? In this case, it would be the insurance companies. How long does it take to generate the cash if you've gotten grants? And I know you have to fill out forms in order to account for the expenses when you get those grants. I don't know if you have to fill out those forms in order to get future dollars out of those grants, but this just tells you how fast it takes you to generate that cash. If it's too low, meaning your accounts receivable turnover is too low, it could indicate that your collection policies are too loose, which means you're not very timely about filing your claims, or people paying, or you tell them net 30 and 90 days later you haven't gotten any monies and you haven't gotten over it. If it's too tight, meaning you're turning it over really, really rapidly, you have to look to see in some organizations, is it so tight and the requirements so big that nobody wants to come to your health centers because they have they can't pay as quickly or things like that. In your case, mostly, I would say make sure that your accounts receivable turnover is, again, somewhere that you're turning those receivables over in a timely fashion so that you have that cash generated for those times that you need. In the organizations that I was a part of, a lot of times, if you have receivables sitting out there with a payer that are very old, sometimes you'll sit down and negotiate with them a settlement. In other words, these are very, very old claims and we need the money. So maybe we'll do a settlement with you for 90 cents on the dollar. I'm making it up, but something, they're old claims. Those are not new claims. These could be claims that have been sitting out there just for a long period of time, and you want that cash in. It might be worthwhile to do something like that. I know in the organization that I was in, sometimes with some of these payers, they didn't even know what they were fighting to get reimbursed for after a period of time. It could be a couple of years. And they actually settled on a certain dollar figure to get the claim gone and get the cash in the door. So it's something that some organizations do look at. Do the financial ratios, again, you're not going to, I'm going to go back up. You're not expected to know how to calculate that. But I would think, and I know in discussions with one of the health center CFOs, the days cash on hand is something that he presents every month to the board members, that they're very interested on knowing the days cash on hand, obviously for the reasons that I said. I know that there have been presentations in the past as how to improve on our accounts receivable collections. What are your processes that your organization does to collect on those patient revenues, those receivables? You might want to, if you're having trouble collecting cash, what are your processes? What could you be doing differently to get those claims paid? What's the holdup that the payer doesn't want to pay you? Those might be some deep dives that you need to take or have your centers take to say, why aren't they paying on these claims? Are we not filing correctly? If we are filing correctly, is there a holdup for some other reason? What can we do to improve the collection on those accounts? And the turnover ratio or days cash on hand ratio will help you see where you may have some opportunities if those numbers are not adequate for your organization. I know that you've all, like 2020, I can't wait for, I want it to be New Year's now, okay? I want it to be a different year like everybody else. 2020 has been really very, very challenging. And I wanted to kind of give you just a few things to look at when you're dealing with an unintentional event, okay? This, right now, it happens to be COVID. You could have anything that unforeseen that could happen in your organization. As a board member, this is what I would be asking your organizations to be doing. Okay, these are just my ideas of things that I think you need to look at. I actually interviewed an organization who was a small, it wasn't a hospital organization, it was actually a center, a smaller health center. And I asked them some questions about what are the first things that you did? And I incorporated some of that into here. Step one, get a trending of the patients that you have by type, by your different programs, okay? Your medical programs, your dental programs, whatever your programs are, get an idea of the tracking and trending over a period of time during COVID, and then compare it to the previous time period before COVID. That will give you an idea of where you've seen some patient fallout. And that would be something that you'd really want to look at, because as you're going to want to forecast what it might look like in a second wave or a third wave of this, you want to look at what was the fallout from the first wave. And you want to look at that patient type, because all those patients generate different kinds of revenues for your organization. Look at the acuity of that patient also. That will play into the types of reimbursement that you get. Obviously, in a surgical patient will have some higher acuity than a pure medical patient. In a lot of cases, there's different revenue reimbursements associated for those two different patient types. And then with your finance person, what they should be coming to you with, what is the change in volume by percent? And again, if let's say there's a 60% reduction in volume due to the first wave of COVID. I'm making these numbers up, okay? So if you had a 60% change in volume between those time periods, pre-COVID to after COVID, you would want to look at that percentage. Is that something you should expect in the second wave? Is that the worst case scenario? Is the best case scenario? You know, those are the kinds of forecasting that your teams of your organization should be doing as they move forward. The second step would be review that cash flow statement. Remember, I told you cash is king. You know, that is your most accurate reflection of where you are at that point in time. There's no accruals, it's what's come in the door and what you've paid out. Again, compare it to the time prior to COVID, to what it has been COVID phase one. Specifically look at the cash you had on hand and your receivables balances for these time periods, because that's going to tell you how to forecast what might be what might you not want to look forward to in the second wave of COVID. Again, what changed in phase 1 to the balance in your cash and receivables? Did it increase or decrease? In a lot of organizations, it decreased. Those that were not part of hospitals, even hospitals, but those who were not part of hospitals, those were, whether they be medical practices or smaller health centers, may have seen a decline in patients because they really had to, unless you were an emergent patient, they didn't see the patients. They closed their doors, or they really brought down their volumes because it wasn't safe to have the patients come in. The third step that you'd want to do is look at your income statement. What changed in your expenses during that time period? Did you notice your supplies went way up even though your revenues did not? Chances are some of that may have happened because you had to bring in PPE equipment that you never imagined having to bring in during this time. You have additional staffing that you needed to bring in. A lot of times when you bring in temporary staffing, it costs you a lot more money. Did you plan for those? Unfortunately, you need to plan in the future. Are your very own healthcare essential workers going to potentially get sick from this? And who are you going to bring in, and how much are you going to have to pay them to come and work for you during this time period? Reverse of that is if you have a program that doesn't necessarily generate revenues or is not essential, is that something that you might need to think cutting the hours? Cutting the hours so that you don't incur the expenses. Rent, you're going to have to pay on the rent. But I mean, if you cut the hours, you bring down some payroll expenses, you bring down some supply expenses. It's not necessarily something you need to do. In this organization that I interviewed, they actually reduced their days in their center by 1. Okay, they went down to 4 days a week. Only were operating under an emergency basis, but in terms of bringing people into their center, they didn't really have the volume to have the center open 5 days a week during this time. So they chose to bring down those, close it so that they could at least bring the supply use and the personnel use down. And then your finance folks should be doing a cash flow forecast, thinking about what's transpired pre-COVID to COVID and utilizing that to say, okay, what might it look like if we had phase 2? If I lost 60% of my volume and revenue in phase 1, should I be forecasting that amount for phase 2 or some semblance of that amount? Maybe 60% was way too much. Maybe phase 2, okay, they're thinking it's not going to be as severe. And we know more now than we did before. So is it going to be a 40% drop or a 25% drop? And there should be some kind of sensitivity analysis done to say, what might it look like going forward? And based upon that, you really do need to look at where you could either bring in some different business. I don't know in an emergency if you could, but it's probably going to fall to, can I borrow some monies to get me through? but more likely is what can I do to bring down those expenses? Review your day's cash on hand. How much cash do you have to stay afloat and pay bills during this second phase? Don't wait for phase 2 or phase 3 to hit you to be looking at ways to improve that day's cash on hand. We know the second wave, and in some cases, the third wave is coming. We should be looking at ways now. It's for COVID, but this could be for any event that transpires. But we should be looking at ways to improve our cash position so we can weather the storm as we go forward. And again, collecting of those debts, okay? Really putting pressure on your processes. If your processes are not strong enough so that you're getting paid, meaning you're not filing your reports or your claims timely, then improve upon your processes. That is up to your obligation as an organization to do that. And you should be doing that anyway. Obviously, as any organization, you want to get paid for the services that you're providing. And what do you need to do to make that happen? You may need to talk to an organization and say, okay, I've presented this. Can you speed up the money collection on this? And I know that there's you get allocated not exactly sure how it is on the kind of CARES money of how it's allocated to each of your organizations. But for that is not specific to, it's specific to a payer, work with that payer to get paid timely, okay? And look at ways to reduce costs so that your expenses don't increase. You know, what overhead costs and staffing costs can you get rid of? You know, furlough non-essential workers. It is a tough thing to think about, but if you're not an essential worker, should we furlough you right now? For that non-essential worker, if you furloughed them or laid them off, at least they could file for unemployment. If you just reduce their hours, they sometimes cannot. So look at it critically to see, are those workers essential to getting us through this next wave? Enhance your collection efforts on your receivables, and renegotiate payment terms with your outside vendors. Everybody's going through this. Can you delay paying? Will they give you some grace in doing that to weather the storm? Can you pay a smaller amount so that your cash out is going for the essential needs, and maybe you can work with your vendors in order to extend that payment time that you're due. Now, I know I'm telling you to collect on all the monies that's due you by the payers very quickly, and then I'm telling you to ask your vendors to see if they would delay. It sounds kind of strange, but it's things that you have to think about doing when you're working with an organization. So that is the end of my formal presentation. I'm happy to entertain any questions that you may have.
Lori, I've been monitoring the chat box, and it appears that the audience, while attentive, hasn't generated questions as of yet. Let's give them some time to digest some of the information, and leave the chat box open for questions and answers. I was curious about just a general question, and I'll just put this to you, since Lori, since you've worn the Chief Operating Officer hat and the CFO hat.
Yes.
Those questions about what to do when you have to make those tough decisions, like the furloughed workers or reducing expenses. I would guess that there's some strategies that are more appealing than others, and you still have to sell them to decision makers.
Right.
So it must be a really challenging position to be put into. Um, do you have some ideas on how that process might work, where you would come up with some preferred strategies versus strategies that you might not want to try until really times are tougher, or that unplanned event has gone on for a longer time period, and it needs are even more critical as time goes on?
You know, it's never easy when you have to furlough people. Uh, Personally, as an executive in the organization, I would take the first step to cut my pay. I know it sounds terrible, but I think that it goes a long way to saying I'm going to reduce my pay and our executive team's pay first in order to keep on some of the other workers. Again, those are tough things to think about. But
Yeah.
I think as you're going through your planning, and you've been through wave number one, I think you need to probably retrospectively go back and look at in your different health centers, what could you have done differently? So, and try and think about those types of folks that maybe just aren't critical in the immediate. When I say furlough, I don't mean necessarily that they forever go away,
Hmm.
because it's not like you don't need them as part of the organization. But if they aren't part of what you critically need to do to take care of your patients that are going through this wave, they're kind of non-essential. Do you still need your executive teams? Sure, you do. But how do they, I mean, you do because you need to run your business. Whatever it looks like, you need to run your business. So I always say, look at your executive team first and say, okay, it probably may not be wise to furlough us. However, we could take a cut in pay during this period of time to assist with this. Non-essential workers, I don't know what they may be in your organizations. If you have marketing people, I hate to say
Hmm.
they're not essential, but hey, I mean, do you need all your finance people? I'll say that. You know, you do need to keep your businesses running. It's just,
Right.
can you job share a little bit? Can you
Mhm.
share your resources? The only downside when you don't furlough people, but you cut their hours, is it doesn't always enable them to get unemployment. And so you have to weigh what's beneficial to your employee also. I have talked to other organizations who say we decided to furlough or lay them off because we needed they needed some kind of an income coming in,
Right.
and they could make, unfortunately, more on unemployment than they
Hmm.
can um, get with cut hours. So those are
Right.
kind of some decisions you have to weigh.
Hmm.
Cutting hours are not the first thing that I would do. I would look at all the unessential expenses that you might be taking on. You also might, and this probably raises a question more, is if you have an unintentional event, it makes you really evaluate everything you're doing in your organization.
Hmm.
I don't know about Indian health centers, but I know in the hospital environment that I came from, several of them, once you have a program, that program is there forever. Nobody ever wants to get rid of a program, even if it's making nothing and really doesn't have any continued benefit. It just seems like it falls under the radar. I think it's a time when you have these unintentional events, when they are over, I think you have to evaluate every program you do and make a very, very tough decisions that do we really need those programs? And I don't say that because of just the unintentional events. Sometimes you have to divest of programs in order to create new programs. And if you have programs out there that really don't meet with your strategy anymore, but they just seem to be there, that's what you should be doing during your strategic planning, is you should be thinking about growing and creating new programs and maybe getting rid of others that don't provide the service anymore that they originally were intended to provide. Those, I would say that you should be doing that anyway. I can just say that it wasn't that easy to do. And I know hospitals were really, really bad at it. And it, you know, sometimes when you do that, it allows you to grow. Otherwise, those losses don't allow you to continue to grow as an organization. And healthcare is changing. So what do you need to provide in the future compared to what you used to provide? Does it make sense anymore? The age of the lost leaders, as we always used to call them, is kind of dwindling. There are a few that you do need to have. Obviously, not everything is necessarily going to be a revenue generator, but you have to look at to see, you know, what are more important. Like I would sit there and say, I would never get rid of a social services program that may not generate revenue. Social services are really, really important to both the physical and emotional health of our patients. But you might have something else out there that isn't necessarily a service, but it's not really necessarily a revenue generator. So those are the kinds of things I would look at. But you know what? Don't wait for these events. You know, always have that kind of an emergency plan out there in case of what might I do, but use COVID, which happens to be the most extreme event we've had, but use COVID as a starting point to evaluate your whole organization. I think that's going to serve you well as board members and as teams. It's going to serve you in your strategic planning. What do we want to be? And what is it that's going to help us weather the storm? And I don't know if you're able to or not. I see you have different sources of revenue. You are not totally reliant on grants, although grants are heavy and federal monies are heavy. But can you go after other services and programs, other kinds of payers? You have the Medicare and the Medicaid, and I know you have the veterans, but those are the types of things to say, you know, what can you participate in? And look to that also, kind of a diversification scenario. But it's a toughie. It's making people and organizations do things they've never had to do before. And I think it's caught a lot of organizations, obviously, unawares. We've always had one, you know, H1N1. I remember preparing for H1N1. Oh my goodness, we prepared and prepared and prepared. And thankfully, everybody pretty much weathered H1N1. But this definitely raised a flag for everybody.
Yeah, I appreciate that. It is a challenge in this when we think of the theme of our training. This era of COVID-19 is full of challenges, and you've given us food for thought to think of opportunities that could emerge from this era. Wanted to highlight a comment in our chat box from one of our participants who said, "Thank you for the finance presentation. It's very appreciated. I liked the visuals. It actually helped me out. Numbers dance in my head, and you made it understandable for me." So I'm gonna add an exclamation point to that. I think that's a nice comment.
I was a little worried about the rubber ducky, to be honest, but I kind of thought it was cute, and I tend to like you know, I understand as a finance person, the numbers, I can look at the numbers and they don't dance in my head. But I'm also I'm different than a normal finance person is I'm a very visual person too.
Hmm.
So I can understand that trying to visually not just put numbers can help people who don't think like I think. Okay,
Hmm.
so hopefully it did resonate, and you'll obviously have this to go back to.
Thank you. Well, your creativity and imagination is appreciated. I think there are a few more maybe announcements or reference slides. If you could advance us to our next slide.
Sure. Just a second here.
Sure.
There. Again, this is
Um,
my information. Yeah.
Thank you, thank you, Lori. We appreciate your input, and again, with your 37 years of experience, you've been able to draw on that to really boil it down to some really useful insights that you've shared with us. So thank you very much for that. Again, Lori is available on LinkedIn. Her email address and other ways of contacting her will be embedded in the slide set, and the course slides will be posted and available to our participants. Could we see the next slide, please?
Sure.
Just a reminder about the rest of our series. Today's series, Understanding Finances, again at 1 p.m. Our next meeting will be this Friday, How to Develop Board Metrics and Ties to Strategic Planning, again from 1 to 3 p.m. Our presenter will be our own director, Zep Fuller. We're looking forward to that presentation. The meeting after that on a Wednesday, November 4th, will be board self-evaluation tools. We actually have a UIO leader as part of that presentation team, and previous trainer from our board of directors who's very familiar with NCUI and NCUI's organizations, Tony Scucci, will be our guest presenters for that November 4th session. And then the final session will feature Rick Mueller from the IHS office. They'll feature tools for urban programs, and I'm sure there'll be a wealth of information shared at that final presentation, again, from 1 to 3 p.m. on November 6th. Next slide, please.
Sorry, guys, I just
Oh,
wanted to quickly chime in. If you could go back to the previous slide, Lori. So that November 4th date, we are kind of toggling right now, as we do understand that's the day after the election. So we're just going to see if we can move this particular session to Friday, November 6th, and then the IHS Tools November 6th webinar to November 11th. So just a heads up on that. So that might be coming up depending on the presenter schedule, but just based off of experience, usually at the day after election, some folks are somber, some folks are just, trying to figure out what the political environment looks like, especially in DC. So we want to be very mindful about staff and again what that political environment's going to be looking like. So just stand by for confirmation and any adjustment that may take place for the November 4th and 6th webinars. Thank you.
thank you for that heads up. I think we do have to be mindful of not only what our audience is going through, but the political and social environment and the moment we're in. Again, that's something in this COVID era that's created challenges that require that not only are we resilient, but fluid in terms of our thinking. Finally, this call to action about registering to vote. We have links. Again, the When We All Vote portal, we encourage you to use the links to go through our National Urban of Indian Family Coalition landing page for When We All Vote. The information on census, of course, it's somewhat dated, but there's always information available to you. The Native People Count links and the Democracy and Indigenous links. Again, I would encourage you to explore those as we round the bend on these final presentations around getting registered to vote. I think, is that our last and final slides?
Yep.
Thank you for your participation. Go ahead.
Another comment for folks as well, for those UIO board members that are on board and those EDs, we still have funding left as well for the Get Out to Vote. So if you would like to increase the amount that you had previously requested for the grant, please give us a call or let us know. We do have extra funding available to get into your hands so that you guys continue to push for the last final week before the election. So it can be used to buy t-shirts, just as long as the funds are spent down, definitely before the I want to say the 2nd of November, that would be great. So just contact us if you're interested in applying for the Get Out to Vote funding.
Sure. Facebook ads and other kinds of social media expenditures would be welcome. Spending down those dollars is really a vital. This is a moment to all hands on deck moment. I'm curious, Noel, are you able to list the link for our evaluation survey in the chat box?
Yeah. So I'll be
Thank you.
dropping that in just a second.
Thank you. The evaluation survey, we'd ask you complete that at the end of our slide set. The evaluation items are brief and shouldn't be time consuming or a heavy lift to ask you to complete our survey. And as a tip for the future, someone in our comment box has noted that those joining via telephone can unmute themselves by pressing *6. I'm sorry I didn't make that instruction clear to telephone users about how to unmute. Pressing *6 on your keypad would allow you to unmute yourself to participate in our conversation.
And just really quickly, for additional webinars coming up, we do have a Moving Your Votes into Action webinar coming up tomorrow. That's going to be an evening special. That'll be at 4 p.m. Pacific Standard Time, 7 p.m. Eastern Standard Time. And so that's going to be for the all general public. If you guys could push that on your social media accounts, that would be great. In addition to that, we also have another Get Out to Vote webinar coming up on Wednesday, the 28th. And that's just going to discuss how you can help increase Native youth civic engagement. So just I wanted to promote those as well. All of these events are on our Facebook page. So if you can push those on your personal pages or even your UIO pages, that would be great. Thanks so much, guys.
Once again, thank you for your participation. That October 27th evening conversation was going to feature our policy team and have a lot of really valuable information about messaging and persuading people to understand the power of their vote and being a full participant in the electoral process. So I hope you'll be able to join us for that conversation on the 27th. And of course, on the 28th, we have our final webinar as part of the Get Out the Vote series. Again, thank you for your participation. Please fill out our SurveyMonkey online survey as a closeout activity for today's training, and we will look forward to seeing you this coming Friday for our 4th session. Thank you, everyone.
Bye-bye.
Bye, everyone. Thank you, Lori. We appreciate all your help.
Thank you.